It's the first Thursday in September, which is crazy, and I'm excited to bring Alex up to chat through some of this week's news. How's it going, Alex?
Great. It's great to see you, Leah. How are you doing?
Good, good. Excited to dive in. So let's kick it right off with National Bank makes $100 million bet on Flinks. Can you tell us what the news is there, Alex?
So, National Bank of Canada, which is, I think, the sixth largest Canadian bank, is taking 80% preferred share stake in Flinks for $103 million. It is doing this by buying doing a $30 million direct investment in the company, and then purchasing preferred shares from current equity holders for $73 million. So you think about $103 million investment gets them 80% of the preferred shares, and it's broken up by investing more in the company and buying some of the shareholders out. You should know that National Bank had previously invested in Flinks via its corporate venture capital arm called NA Ventures, and NA Ventures is quite an active venture capital arm. It has investments in lots of different companies, including Nest Wealth, Mocha, Security, and many others you would be familiar with.
So let's take a step back. What does Flinks do?
So the best way to think about Flinks, it enables software providers or apps to basically do two things. One is to pull data from their customers' banking accounts and other financial accounts. So if you ever think of something you sign up, like let's say Uber or Wealthsimple, and you're a customer of, let's say, National Bank, to get that information to go between those two entities, Flinks provides that link. The second thing it does, it also provides what they call a data enrichment product. It can turn financial data into insights for a company's business operations. So it could say, hey, we've noticed that when A happens, B quickly follows. So if you can get someone to deposit into your Wealthsimple account within the first 5 days, odds are they'll start depositing regularly. So it provides two things: makes your financial accounts of customers talk to your business, makes it easy to access them, and then it helps you provide additional insights from there. If you look at who their customers are, they are lending, fintech, digital banking, asset managers, insurance industries. I imagine they are either new startups or the disruptors, or old companies that don't offer all these services that want to offer more services and pull assets information from their customers' current financial service providers.
So why raise funds and why raise them now?
Yeah, it's good question. And I think Flinks has been relatively successful, but they've always been historically relatively quiet about how successful they are. What they've said with these funds in particular was, this is growth capital we use for rapid acceleration of the company strategy to enter the United States. They were sort of Canada focused. They've gone to the States. They're claiming it was successful. They need more headcount. They need more capital to basically attack this market. So this investment is going to keep that fast-paced growth up. They're also trying to expand into more fintechs, asset manager, credit unions, and it wants to grab its market share in wealth and lending space. So basically, this is capital to improve their products, to have more sales team, to be more aggressive in the States. The bigger question is, why do they raise the money now, and why do they sell majority of the business?
Yeah, so that's where I think most folks, myself included, are confused. Like, that's a big chunk of the company that they're getting rid of for $100 million. So what do you think? Why would they do something like that?
Yeah, so the timing is odd. Like, according to the co-founder and CEO, he told BetaKit that they weren't looking for additional funding right now, or in September they weren't planning on raising, especially after a successful launch by Flinks in the United States. So when I think about it, no insider information provided here. This is just pure speculation. There's a few reasons you want to do this. One is the headlines are a bit wrong. It specifically says they sold 80% of preferred shares. When companies are structured, you have preferred shares and you have common shares. Usually, the common shares are the founder shares, and the preferred shares are investor shares. So maybe the founders still have a majority of ownership.
Interesting.
National Bank offered great valuation. The current investors needed to return, or said, okay, we'll take money off the table. That could be one scenario. Or the company needed additional capital, either because it's competing with Plaid in the States and need a ton more capital to be actually relevant, or they actually have some venture debt. Maybe they broke some of the covenants. Again, no reason to believe this. And either way, they felt they need more equity. What would be weird is if they had a successful launch, if they're doing really well, I think you could have raised a ton of money from all the venture capitalists that missed Plaid and want to get into the next Plaid. So something there does something like these are the reasons I could see. None of them really stack up because, like you said, if you're a successful company, like it's very odd to take, you take some secondaries, and even investors want to get out, but usually don't sell the majority of the company. So either the headlines are wrong or something is not as good as we were led to believe.
And they just had quite a successful launch in the States, right?
Yeah, well, that's what they're claiming, right? So if it's successful, like yeah, look, my view is if it's successful and you've got killer numbers, you should be able to go raise money from tons of different VCs at the valuation of your choice in this current market. If it was tepid, or maybe you didn't have many suitors at the table, like so, there's something here which, without insider information, I don't really get it.
Something's not adding up.
Yeah.
So other than sort of like the interest of the scandal and sort of mystery around it, why should TechTO community care about it?
So I don't think it's a scandal. I think, look, Grant, if you take a step back, using the words you said before, this is an amazing outcome for the investors, for the founders, and there is a successful, large, growing business here. It might just not have as much momentum we think it has. So the takeaways I have, first of all, when you see majority stakes sold without press release, and usually you don't have the press release if it's not a full acquisition, it's hard to understand the implications of the deal. Second of all, either way, we know that you look at what National Bank is doing, and they're extremely active both as an investor and a bank redefining what it does. They have NA Ventures. If you go look at their portfolios, quite active, one of probably more active corporate investors out there. Shopify does these big deals, high profile, but NA Ventures is they're just slowly investing in lots of companies. And the second thing is, as a bank, they're doing a lot of interesting things. I guess, being bank number 6, it's sort of like Hertz, we try harder. I think National Bank is doing a lot more interesting things a lot quicker because they're in a position where they can be a challenger bank that already has an established bank that can be a challenger bank. So if you're a fintech company in Canada, you're looking for capital or partner for distribution or to do something cool with, you have to talk to National Bank. Next thing is, if Flinks is taking on a behemoth of a competitor in Plaid. It's we love to see that attitude. I think more Canadian companies should be ambitious. But when you see what they're trying to do and you look at the National Bank investment here, you can think of it from one of two ways. Either this is they needed more capital because things are going so well. They didn't want to take the foot off the gas pedal, and hey, National Bank said, here's a deal. Here's $30 million. Let's go quickly for it. Or they just, they're facing, they hit a brick wall and they need capital just to make sure to keep them going. Either ways, this might be also important to market timing and how hard it's taken, in a rapidly growing tech startup. Like Plaid's last round they raised over 400 million USD, and I think until this raise, Flinks had raised about $19 million. So you can see Plaid raised 20 times in the one round what Flinks raised, and so like they can just basically outspend Flinks. And
is Plaid in Canada, or have they expanded up here yet?
Yeah, Plaid. So like even if you look at what you'll see is from what from lots of startups I've seen, they don't use one company exclusively, right? So the smart companies, they figure out which is the best company to integrate for which best customer iteration. So so for example, Plaid may hypothetically work better getting data out of RBC and TD, and Flinks may at Bank of America and CIBC. So you may go to Wealthsimple, you may give it access to your account, and it may be using a different service behind there. So Plaid was already up here. Flinks started off focused on the Canadian market. So my guess is they have a better solution for most Canadian connectivity. And there's probably different types of assets. Like also you have to remember, like you go to like TD, and I've had this personal experience recently, you talk with TD, the investment arm and the retail bank and this other bank, they're actually 3 different systems. So you might even have Plaid's getting stuff out of your checking account, while Flinks may work better with your current investment arm at TD. So it's they're both competing heads on.
Such an interesting take. And folks, if you are interested in hearing more about what Alex has to think about this, you have to check out our newsletter tomorrow, where we'll be diving a little bit deeper into this Flinks story and more into Alex's thoughts. What else can folks expect from tomorrow's newsletter, Alex?
Well, I'm sure we'll have a company profile, some must reads, And basically, Fridays is all about what's happening in the ecosystem. Here's cool companies, here's must reads, here's good news or news. So if you want your weekly update on what's happening in Canadian tech, you have to be subscribing to our email.
Absolutely. And on that note, we'll move on to the next story, which is Vice is too much to handle for SPACs and raises 85 million. Alex, what is going on there?
So Montreal founded Vice Media has ended talks to go public with a special purpose acquisition company, or SPAC, for the time being, and raised 85 million USD from existing investors. At least that's according to a report from the information.
And for folks who don't know, or maybe have been living under a rock, what does Vice do?
Well, come on, Leah. Do you watch? You must. I feel like you're the Leah. You're the Vice's target audience. So why don't you
Yeah,
describe to me what
I'm
Vice
an
does?
under 30 person living in metropolitan Canada, pretty much directed directly at me. But for folks that maybe don't read it on the daily or don't access their content.
Yeah. So Vice is actually an interesting company. It was started in Montreal, I guess, a long time ago. It was started as Vice magazine, and the founders expanded, primarily into digital media, focused on what they call youth and youth adult focused audiences. So includes online content verticals, web series, a news division, a film production studio. And in 2005, they were called a poster child for new media success, especially when it comes to attracting to the valuable millennial audience. And part of their journey, they've raised 1.6 million in financing, debt, private equity. Like I was trying to figure out how much was primary. Like usually, I focus on how much is primary capital raised. I can't tell but it's they've had a ton of capital, $1.6 billion.
And for folks that don't know, they really have like a corner on the YouTube news market. They've been really, really, really successful there. And like they're always in mine and everyone around me most recommended. So they really have like come into what new media is. They're always sort of ahead of the game on what's interesting and what's cool for, like Alex said, the millennial folks. So what happened? They're now raising money. It doesn't really make a lot of sense. Like what's the story here and why? What happened there?
So they were going to go just being a SPAC boom. We've talked a bit about it over the last 6 months. Lots of these SPACs have looked at digital media companies to merge with them, and Vice was going to raise money by going public through a SPAC funded by a company called 7GC and Co. But for some reason that merger's being the rumors the merger's being called off, and existing investors like James Murdoch and Sixth Street Partners have agreed to invest in the company with the focus on finally achieving profitability. If you look at it, this is a trend of this is like, again, 2015. This was a darling. Vice Media was everywhere. This is what you wanted to build, and it seems like the last few years have been a rough road. The SPAC was supposedly rumored to be valuing the company, or valuing the company at 2.5 billion, which is about 50% over 50% less than its valuation in 2017 at 5.7 billion. The company did a round of layoffs, laying 20 people in the last little while. Like they went from being a super fast rocket. The company's sort of there, but just you don't hear much good news from it recently. So big company, just the news here is they're not profitable. They probably growth is stalled on the top line. People want to see profitability for media companies. It's funny. You've seen in the last 12 months, media companies either that have created the brand, who've got cash flow, get extremely well valued and go public, and then you've seen everyone else struggle that have been promising profitability or cash flow for years, just continue to struggle to raise money. Can't hear you, Leah.
So what do you think the trend is here? Why do you think so many media companies, not just Vice, have kind of like stalled out while there's some superstars that have kind of cut through and made it above everyone else?
Well, I don't think it's a media problem. I think it's a business model problem. I think lots of these new digital media companies started relying too much on advertising, then went to e-commerce. And what they found is advertising is really a game at scale. Historically, you have to have a lot of scale, and then you get disproportionate. Your slots become more valuable, and so I think you've just never seen the revenue be able to overtake the cost, because to because lots of these media companies raised a lot of money and built a huge staff. And so now they're being attacked by, one end you have the Googles, Facebooks of the world that aren't necessarily media companies, but have a lot of advertising dollars, much easier to spend money on. And you have a lot of people like doing Substacks. Say, hey, it's a reporter of one. She goes and starts the company, gets 10,000 subscribers, paying $10 a month. So that's what's even like 5,000 subscribers, $10 a month. That's 50,000. She's getting 600,000. So you're getting lots of media personality going and building their own small businesses, or like Joe Rogan's of the world, which is not a small business. And so lots of these media companies that haven't worked haven't figured out a model that works. So you're seeing ones that have done subscription or more focused, or that found the right business model work. And I think it's these companies that were early, scale quickly, never had the revenues, and it's hard. Like once you get you're relying on advertising, you add e-commerce, but then you're like, okay, maybe we should go to subscription, but then you have to take that long-term pain, which they maybe couldn't have taken. So just I think it was more timing of where the business models were not mature and they got too big too fast.
And like you said, it's more accessible, and there's a component of community there that comes with some of these smaller creators that has changed the game as well. But anyway, back to the main story. Why should the TechTO community care? Why should people be paying attention?
So we talk a lot about valuations on Quick Takes and just in the community as a whole. And this is reminding that while private companies may have high valuations, they're not, in a certain way, they're not meaningful in the company's either public or acquired. And because a company can go up high in valuation quickly, and unless you're taking cash off the way as an investor or owner or an employee, it is a number on paper that you can't go spend. I can't go and spend 5 shares at, I don't want to pick any company, TechTO if we had shares, right? I'm going to go to the store and go to Amazon and go like, yeah, nice. It's not fungible, as a crypto crowd would say. And so while we see these valuations, we celebrate them until the company's either cash flow positive and can basically control their own destiny, or they go public or acquired. The numbers are nice, but not impactful. Vice Media is also the poster child for like digital media business that were supposed to revolutionize the industry. They were everywhere. They could raise easy money. The market turned. They never earned a profit, and they have to keep on retrenching. So it shows you can ride a trend and get lots of valuation if you're leading it, but eventually the trends die out and you have to be real business. And finally, this is a reminder that no deal is done until the money's in the bank. For example, the SPAC looks like SPACs are getting more selective. They're pulling some deals away. The mergers are not happening. Another one with Topps was go public via SPAC. That deal got pulled because Topps lost the right to baseball. It's kind of hard when you're making baseball cards and you can't make them anymore. I've seen this. It also happens in the private market too. This company says you're going to lead around, and then I don't know, something happens in there. So don't count a deal done until you have the money in the bank.
So it sounds like we should be watching to see if this actually happens in the next couple of months, if this is a temporary solution, or if we're actually going to see that SPAC happen. And on that note of media, TechTO has a very exciting fall coming up. Over the next couple of weeks, we are announcing our new fall lineup. This hasn't actually been announced anywhere yet, so you're getting the inside scoop. But this fall, you can look forward to a growth marketing series, a crypto series, a founder fundamental series, and then some of your favorites are coming back. We're bringing back Perfecting the Pitch, Founders and Funding, and a few of our other greatest hits. Alex, what are you excited for to
I actually haven't asked for the community, because one thing we want to do is walk through successful decks. If there's a founder in Canada that you said, I would love to see her deck, I would love to see what they raised off, and we can just suggest in social media, reach out to us by email, and we'll reach out to those founders and see if we can get them to share their secret sauce.
Love that. I think there's so many well-kept secrets of the trade that we're excited to dive into with our audience. And actually, on that note, we're talking about Top Hat's next acquisition. Alex, what happened here?
So Top Hat purchased Denver-based Morton Publishing Co. Morton is a 44-year-old independent press that publishes 600 plus lab and course materials focused on sciences, which are used at 1,500 plus institutions in the United States. And the price wasn't disclosed, but we're estimating it's between 20 and 30 million.
Isn't this Top Hat's 5th acquisition this year? This must be, I feel like we talk about it every 3 months. There's a new acquisition.
Yeah, so Top Hat has been active. This is their 4th. I think they've done non-publisher, but the 4th publisher they purchased, right? And this is these are people again, I'm not a millennial. Maybe I'm at the tip of the millennial, or maybe Gen X, who knows? Maybe I'm a boomer according to Jason. But anyways, when I went to school, you used to get these books, right? expensive books, $300, $200. I don't know. They're always a ripoff. So there's a lot of these publishers, and Top Hat, when they even started, their strategy was like people have to be going to digital media. Like these books are ridiculously expensive. So after they raised their big round in early 2021, they've been buying these traditional publishers to basically enable them to go digital to change their business model. So they bought this. I think they've acquired Nelson's Canadian higher ed business, Blue Door, and Fountainhead Press. So that plus this one, which gives them now about 1,900 books or courses that they own.
Oh, I think we have lost Alex, but we will bring him back on up now. Hey, Alex, are you back?
Yeah, I'm back.
Okay, awesome. We just lost you there for a sec. You had just wrapped up who they had acquired.
Yes, and I was saying that brings them to about 1,900 courses and books that they can publish right now. So Top Hat is slowly buying up the textbook publishing industry and digitizing it.
And so why make the acquisition? Like, we understand that they're buying out the traditional media or the traditional textbook space, but is there anything else there that would push to it? I know they just raised a Series E or D, I believe.
Yeah, I think it was a Series E. It was $130 million, which brings their total financing to date to 234 million USD. So it was purposely done to acquire these companies. So if you think what Top Hat does, they're an all-in-one teaching platform that enables active learning. That's what they call it. Provides what they say student-centered teaching pedagogy to promote deep understanding. Basically they're helping university students and universities change the way they teach. They start off with their clicker, their interactive audience, so they're just keeping owning more of a platform. So what's interesting is where they are is they have products that work, they have distribution, and they now go by publishers, which they can help those publishers transform into digital strategy, gives them more products to sell, gives them bigger share of wallet with the students and the universities, and reinforces distribution. So Top Hat was a place where they're very strong, and they buy these products, it's accelerating growth, and they can add value. It's accretive. So this is the vision, what they want to do at the beginning, and they're now executing it, which is amazing.
So why should the TechTO community be paying attention to this? Why should they care?
Well, first, EdTech is hot, especially in Toronto, Waterloo, where you see Applyboard and Top Hat have raised big money. They're very active. You got Desire to Learn. You got Prodigy. You've got a lot of exciting Toronto, Waterloo EdTech companies that are doing really well. The interesting thing with both Applyboard and Top Hat, universities had a pretty crummy year due to COVID. Like they went remote. I'm sure lots of students reneged on going to school or just postponed it. But here's two companies that serve those industries that probably got strengthened by this. If you look at Applyboard, they need more universities want to attract foreign students. So that's what Applyboard is more critical than ever. Top Hat makes it digital. If you're doing remote classes, if you want to make school more affordable at the edges, Top Hat's more important. Their suppliers, the people they're buying probably had a crummy year because people are less incentivized to buy physical books, so they could probably acquire publishers cheaper. So if you look at EdTech's hot, but more importantly here, just because if you're well financed and you have a good strategy, you can have a tough year in your industry, but take that to advantage. You can build a strategy, can be flexible to come out stronger and to take advantage of other people's weaknesses, which I see Top Hat doing here. Another interesting thing is we've talked about companies going through acquisition like Lightspeed and a couple other Canadian tech companies. They're typically buying other tech companies. Top Hat's model here is interesting. They're going and buying the companies that are basically disrupting. So I've very rarely seen this being used, and I think it could be an interesting strategy saying, hey, we're disrupting an industry, but there's assets or relationships we want to buy in a product that's good. We might be in a position where we can buy with currency or cash because every dollar we earn or it's going to be more valuable to us, and those companies are suffering. So you may be disrupting something, but they might have something that's valuable. You can go buy cost effectively and grow faster. And I think those are the key things.
And I think it's a huge win for the Canadian tech ecosystem. I feel like Top Hat is one of those unicorns we can't stop talking about. I feel like we talk about Mike at least once every 2 or 3 months because they're always doing something.
Yeah. Well, remember, Mike's no longer there.
Oh, he's not. You're right. Yeah. I forgot about that.
He found a hand-picked replacement to be CEO. So Mike took it so far, and he's and he said, okay, now it's time to play a different game, which is also another takeaway for lots of our founders, right? Like, everyone thinks of Mark Zuckerberg or, Jeff Bezos till recently. Look, just because you started a company doesn't mean you have to take it till it's sold or till you die.
Yeah.
And I think it's actually quite commendable when someone says, okay, I've got to where I want to get, I want to get someone that can execute the next stage better than me.
And it shows that they're in it to build this company, right? It's not, it's about building a successful company and not as much about personal gain and, being very self-aware. And I think that it is, like you said, such a commendable thing that I think we'll be seeing more and more of, just as folks sort of like realize that this is a possibility and a way to grow the business. Well, that's it for this week's Canadian tech news. Alex, thanks so much for sharing with us this week. Excited to hear some more quick takes and must reads in tomorrow's email. And if you haven't already, be sure you subscribe to our TechTO newsletter and wherever you're watching or listening, and we will see you on the inside.
We're in the business of delivering impossible things. We're in the business of delivering things that nobody's ever seen before.
If you build that culture, you'll come up with really cool and innovative stuff, and literally could be in the next multi-billion-dollar idea. So this conversation is largely going to be about scaling yourself and scaling your leadership team.
I want to talk about one of the biggest struggles that I think a lot of startups face early on, which is building initial traction.